Let's finish up by talking about installment loans. With an installment loan, as opposed to a single payment loan, you're repaying debt in a series of equal payments. So each payment includes some principal and some interest, or said another way, a portion of each payment goes to principal and a portion goes to interest, but not the same portion with each payment. So there's a wide maturity range on these types of loans. So they could be short-term, medium-term, or long-term. So just as we did with the single payment loan, let's calculate finance charges on installment loans. With the simple interest method, the finance charge will be calculated on the outstanding balance, although that outstanding balance is declining each period. With the add-on method, finance charges are calculated on the original loan balance added to the principal. So let's go back to that example we had before. If we have a $1,000 loan, but now it's going to be repaid in 12 monthly installments, still at that 8% interest rate. So in your textbook, there's an exhibit that shows the interest calculations for a $1,000 loan. And searching for the page, it's exhibit 7.5, so that's going to be on page yeah, it's not exhibit 7.5, it's exhibit 7.4 on page 190. And so what we're doing in this exhibit was we're trying to find the monthly payment for that $1,000 loan at 8% interest. So you'll look at that first column and go down to where it says 8%, and then you'll notice that there's already a box around the number that we're looking for, because we're going to start on the row where the interest rate is 8% and then move to the right across that row until we get to the column for 12 months. And that gives us our loan payment of $86.99. So now if we had a financial calculator, what we would do is we would say that our present value is actually, I like to think of it as a positive $1,000, where someone gave us $1,000 or loaned it to us. The interest rate is 8 because we always put the rates in as whole numbers, so not 0.08, but just the number 8. And then N is 12 because we're looking for a monthly payment, so we need a monthly we need the number of months. And so actually, I prefer to, instead of, as this says, put the payments per year as 12, I like to put it as 1. And so if you put it as 1, then you have to change your interest rate to 8 divided by 12 to get a monthly interest rate. I just like to be consistent. I'm putting in months, so I want a monthly interest rate, and I just change it as I need to with every problem. But either way, when you solve for the payment, so you hit compute payment, you'll get the same result, $86.99. So on the simple interest method, the interest or finance charge is calculated on the outstanding loan balance per period, or each period, and the payment decreases the outstanding loan balance. So your later payments would actually have a lower finance charge because it's based on a lower balance. And so that's why we're saying the amount that goes to principal and interest changes even though the payment amount stays the same. So in the beginning, much more of your payment goes toward interest, and as that balance goes down, more of it goes towards principal. So the total amount paid over 12 months is going to be the $86.99 times 12, which gives you the total amount of the payments. And so the loan amount was $1,000. Remember, we're paying off this loan in 12 months with those 12 monthly payments of $86.99. So if we subtract off the loan amount, the interest that we paid was $43.88. Now with the add-on method, we're going to calculate finance charges on the original loan amount. So we take $1,000 that we borrowed times 8% times 1 because it's for 1 year, and we get $80. So we add those charges to the principal, So then that means it's $1,080. And we divide that by the number of periods to get the payment. So it's going to be 1,080 divided by 12 gives us a monthly payment of $90. So it's a little bit higher with this add-on payment than with the simple interest method. So to use the financial calculator to figure out the APR for the add-on method, here's what we would do. The present value is still $1,000. Now the payment is $90 because that's what we got with the add-on method. We still have 12 months to pay, and then we're going to solve for the interest rate. And we get 14.45%. So that's a lot higher than the 8%. So a couple of things to wrap up, some other things to consider. Are there prepayment penalties? Consider the rule of 78s. And the rule of 78s is on page 192, and that's a method for calculating interest that has heavier interest in the early months. And so that's another method that you should know something about in case you're ever charged interest using that method. Credit life insurance, that's typically optional, and so if you opt in to credit life insurance, then that insurance would kick in and make your payments for you in case you were sick or disabled and couldn't make them yourself. Another question is, am I better off just paying cash instead of taking out a loan to make this purchase? So here's a comparison between simple interest and add-on interest. So this is the example that we just did. We had a stated rate on both loans of 8%, but our finance charges with simple interest was $43.88, but $80 with add-on interest. Monthly payments were a little bit closer, but the total payments was a bit higher, and the APR was much higher for the add-on interest alone.